Okay, hello everyone. A very good afternoon, a very good evening, and welcome to yet another beautiful episode that we've organized for you under the AIKI domain. So this particular session, we are going to have a very interesting discussion on, how to invest abroad through mutual funds. And we have with us, a very an expert who's going to tell us about how that can be done. So we have Mr. Chintan Haria, who's the head for product development and strategy at ICICI Prudential AMC, and we are going to be having a lot of interesting discussions. I would request all of you to keep the questions going because we're going to dedicate a decent amount of time to take your questions. So the structure is that I'm going to take first 5 to 10 minutes to set the base, and then we'll have Chintan who will give us more expert views on this particular topic, followed by Q&A. Right. So feel free to ask all your questions, and we should be able to answer most of them for you. Okay. So let's get started, and let me quickly share my screen with all of you. Just a moment. Okay. So I'm just guessing my screen is visible. Yes. Okay. So today, since we're going to be discussing about how to invest abroad through mutual funds, I thought it was only fair that, we quickly give you a brief about how it's done. This is a topic which a lot of people have asked about. It's a topic which people are really interested in because, of course, the markets are doing well. And, we get asked this question a lot that as an economy, India is doing exceptionally well, right? I mean, we are expected to do very well in terms of our GDP. And then in the coming years, we are expected to be the fastest growing economy in the world. Especially after COVID, we have the most of the countries who are implementing the China Plus One strategy. So China Plus One strategy is nothing but, China is the manufacturer of the world, but then now a lot of countries are looking at moving outside of China for their manufacturing capability. And I think India is going to be a big beneficiary in this whole thing. And if you look at all the positives, it looks nice, right? I mean, we want to believe that if India is going to do so well, then why should we look at investing in international markets? And I'm sure a lot of you would have that question as well. So I'm going to explain in very simple terms why is it that you should look at international markets for the sake of diversification, and what is it that can be done, so how you can go about investing in international markets. Okay. So there are three benefits of investing in international markets. One is for the sake of diversification, like I said. Then it allows you to participate in the growth stories of all the companies that you actually use and utilize on a daily basis, but then they're not listed on the Indian Stock Exchange. So then, how do you, become a part of the growth story of those companies? And then, of course, protection from rupee depreciation. And we're going to talk about all these aspects. So let's quickly start with the whole diversification part, right? Which we keep talking about. Diversification is a big theme. All of us talk about it. So, what exactly is diversification? So, we have two types of risk. There's unsystematic risk and there's a systematic risk. So, for example, if you invested in one company stocks, or if you invested in one mutual fund scheme or one specific sector, then think of the kind of risk that you have, right? We call that as unsystematic risk because that's the kind of risk which you can diversify. So instead of investing in one company stocks, you diversify. You invest across different stocks. You invest across different mutual funds, or you invest across different sectors. Your risk can be reduced. But then we have something called a systematic risk, which is nothing but your market risk. Now, this is also called undiversifiable risk because this is a risk that impacts the whole economy, that impacts the whole country, right? So think of it as inflation, or any new tax regime introduced by the government, or any it could just be any new plans which the government is coming up with, which is impacting the economy in the short term. So, for example, introduction of GST or demonetization were systemic corrections, but they did have an impact on the economy in the short term, right? And that's systematic risk. So then the question is, can you diversify systematic risk, or can you reduce that risk? So to reduce that risk, we talk about investing in international markets. So you can invest in international markets and reduce that risk. So if you just look at the relationship between India and US markets, right? So here's a very simple comparison between Dow Jones and Sensex. And if you specifically look at 2011 and 2015, to a large extent, you would say that they have a positive correlation. But these 2 years, they do seem to have a slight negative correlation. When one economy was negative, the other one was doing slightly better. Okay. So there is a negative correlation at times, which can help you in terms of, balancing out your risk. So you invest in two different economies and your risk gets balanced out there. Then if we just look at why investing in US markets, I mean, I personally think US and developed markets cannot be ignored because look at the size. I mean, in 2003, US and developed markets contributed to almost 90% of the global equity market capitalization, right? Of course, that reduced in 2018. So in 2018, it was close to 77%, and you had 23% of the equity market capitalization taken by emerging markets like China and India and other countries. But all I'm trying to tell you is that the developed markets are too big to ignore. And since you cannot ignore it, you might as well be part of it, right? Then you have, being part of the growth stories. Now, this is really interesting because, there's so many companies whose products and services we consume on a daily basis. So it could be companies like Google and Facebook, Toyota, Amazon, Netflix, Coca-Cola. You name them and we're using their products. And I think if we believe in these companies, if we believe that they're expected to do well in the future, if we believe that these companies are going to be the unicorns, or they already are the unicorns, and they're going to do exceptionally well, then how can we be a part of those companies? So we can be part of these companies by investing in international markets, because if they're not listed on the Indian Stock Exchange, we don't have much of an option left, right? So which is why I do think that you will be missing out on a lot of opportunities if you don't really invest in international markets, because you have so many companies that do exceptionally well and you want to be a part of that growth story. So if I just show you the Netflix saga, right? Netflix is a very interesting story. So by the way, Netflix is one of those stocks which is the highly most traded stock on the US stock market. And in the first half of 2020, Netflix added 25 million subscribers. And by the end of 2020, the total subscriber base was 193 million, which rose from 151.1 million by the end of 2019. So, the Netflix stock price, if you just look, it was almost just what $4 in 2008, 2009. And in 2020, 21, this was 613. That's 143 times in 12 years. That's Netflix for you, right? So what I'm trying to tell you is, if you look at companies like Netflix, right, and you're like, why couldn't I be a part of this growth story, right? So that's what I'm saying, that there's so many companies that you could be a part of. Then you have so many sectors. So think of the pharma sector. The pharma sector is expected to benefit immensely because of the COVID vaccine market, right? Which is expected to touch a $20 billion mark by 2026. The market size is only expected to grow because of the booster shots which are introduced and which are going to be introduced. So what I'm trying to tell you is that pharma sector, which has companies like J&J and Pfizer and Novo Nordisk and so many other big companies which are not in India, which are not part of the Indian market. So then you don't have much of an option left there. The semiconductor space, which is huge. Last year, semiconductor space was big. I mean, all thanks to all of us using laptops and mobile phones and our own personal vehicles, the semiconductor space became huge. There was so much demand that the companies were not able to fulfill that demand. So now, if when the demand starts getting fulfilled, just imagine the kind of growth that you will see in the semiconductor space in the coming few years. And all these companies, if you see, the biggest of the biggest semiconductor companies are not in India; they are located outside of India, right? And that provides you another interesting opportunity to be looking at. Then we're looking at managing currency depreciation risk. Now, when we look at 2008, the global crisis, all of us know about it. All of us have been a part of it, have seen it in some form. We might have been either working at that time or maybe in college or whatever, right? Now, if we look at the 2008, the global crisis that happened, what exactly happened was, of course, the meltdown shook the whole economy. There was a lot of chaos at that time, and to support to support the economies, most of the countries came up with quantitative easing and interest rate cuts. Now, these are very standard measures which countries take to really infuse liquidity into the market, right? So at the end of 2008, you had most of the countries infusing liquidity through these two measures. Quantitative easing is nothing but printing of notes. Now, these two measures are not sustainable in the long run, right? You can't be doing this all the time. It's obviously a short-term measure. So in 2013, US markets decided to reduce quantitative easing and increase the interest rates. Now, this is called tapering. And what happened with that? So what happened is that when the interest rates are going up in the US markets, the developing markets were the ones that became vulnerable. So there was a reverse flow of money that happened from emerging markets to the US and other developed markets. And obviously, because of this, rupee started depreciating. So at the beginning of 2013, so let me just show you this. At the beginning of 2013, where the exchange rate was close to 54 rupees a dollar, by the end of August 2013, it was 68 rupees per dollar. That's a 26% depreciation that we saw in just a span of 8 months. And obviously, this would then result in current account deficit. It resulted in inflation and so on. And our markets obviously, felt the impact. So if you just see this, I'm just showing you the 2013 journey. In 2013, if you can see, Sensex, when Sensex was negative, you saw the US indices doing well. So there was Dow Jones and Nasdaq, which actually were positive at that point in time. They were moving in opposite directions. So what I'm trying to say is that when that negative correlation comes, it happened because of currency depreciation. It just makes sense to be a part of those international markets and balance out your risk at that point in time, right? So I'm just showing you these very simple things so that you understand that there are a lot of benefits of investing in international markets, which can help, of course, from diversification point of view, but in general. So if you just look at what are the ways of investing in international markets, just quickly, so you have your fund of funds, then you have your active international funds, and you have your passive international funds. So fund of funds are funds which are investing in other funds, either one mutual fund or multiple mutual fund schemes. Active international funds, where the fund manager would invest in foreign stocks, and passive international funds would be where the fund manager is investing in a particular foreign index, right? The theme remains the same. It's just that now you're investing in the international markets. So these are the three different categories of mutual funds that you could look at from an investment point of view in international mutual funds. Then, of course, what are the geographies that you could consider? So you have US, China, APAC, Europe, emerging markets, and of course the global, right? So if I just show you the differentiation, so developed markets would be these countries. So your America, Canada, United States, and then you have a lot of developed countries in Europe and Middle East, so Austria, Belgium, Denmark, Finland, and so on. And then you have the Pacific, your Australia, Hong Kong, Japan. And your emerging markets is where we fall in, right? So we have India, China, Indonesia, and the Asian space, and so on. So this is the complete, index, or complete breakup of developed markets, emerging markets, and then of course you have the frontier markets. So investing in international funds, I would say if you're looking at a breakup, look at say 80 to 90% in the Indian market, and you, for the sake of diversification, you could look at say 10 to 20% in international markets, right? And when you're selecting your international funds, you could consider a combination of, from multiple global markets. It could be funds from US or global markets or China and so on. And obviously, you could decide between active funds or feeder funds, or we call them fund of funds and so on. And that obviously depends on your groundwork. So just the last slide to tell you that if you were to invest 100% in domestic equity versus an asset allocation where 80% was invested in domestic equity and 20% was invested in international funds, then what would your returns look like? So your red line shows 100% in domestic, and the blue line shows you that asset allocation. And as you can see, there is obviously a slight improvement, and asset allocation has always done better compared to 100% investment in domestic equities. And look at the the CAGR. So over a 7-8 year time horizon, 100% domestic equities would have given about 12.74%, whereas the asset allocation gave you about 15%. So obviously there are those benefits that we look at from investing in international markets. And of course, now I'll pass it on to Chintan, who will probably explain a lot more in detail. I just gave you a quick brief. So yeah, thank you so much. Chintan, over to you.
Yeah, thank you. I think in exams we used to have prelims and boards or final exams, so it's going to be similar, wherein whatever has been explained so beautifully, I'll be revising it, but maybe in a different manner, slightly more elaborated manner. So I also have a few slides to show, and of course, do keep your questions coming based on whatever your queries would be. We try to answer them after I finish. I'll probably keep it short in terms of the next 15 minutes or so. Yeah. I'm just sharing the screen. one of the reasons why we want to basically invest globally is the fact that there are certain sectors, certain thought processes, certain innovations which are not available in India, right? So we have a scenario um, wherein if we look at, let's say, electric vehicles. Now, electric vehicles in terms of a thought process is something which all of us relate to. In India also, there's been a launch of electric vehicles which has happened. But maybe 5 years, 10 years back, the electric vehicles was thought of and the entire ecosystem was being created globally. And there were many companies. Now that has been obviously expanding. You have battery makers which are making lithium ion. There are hydrogen companies as well, which basically there are hydrogen buses, etc. So there are so many things which are happening globally where India may not have a representation in the listed space. The objective of our investments is to participate in any area where there can potentially be growth. And if that sector or that particular segment is not available in India, why not participate outside? That is one of the key areas which was also highlighted in the previous presentation which was going on, that there is so many sectors and thought processes which are not available in India. Think about artificial intelligence, cloud computing, driverless cars. Uh, these are new to India. Cloud computing, for example, right? Today, most of our servers or most of our uh, softwares are hosted on the cloud. Cloud by itself in India is now new, but many of the large corporates globally are very big into cloud computing. Typically, stocks like Microsoft or Amazon Web Services, they are very large in cloud computing. So, to get the advantage of the changing world, because many of these innovations happen when you spend on research and development, right? And just to give an example, right, the average research and development spend by the Nasdaq 100 companies, just as a thought process, I'm taking that as a universe because that is considered to be the technology or innovation hub, is about 80,000 crore Indian rupees equivalent, about $10 billion. So you think about it, very few Indian companies actually have even top line, that is sales of 80,000 crores. Your annually average spend by a Nasdaq 100 company, average spend, each company on an average is spending about 80,000 crores on research and development. What does that do? That enables new product innovation, that enables improvement of the existing product, that also enables our goods and services or their goods and services to be cutting edge. And we all have been beneficiaries of it. In fact, this dialogue between us today wouldn't have been possible without the improvement in bandwidths, without the improvement in chips, without the improvement in availability of telecommunications and the softwares which allow video streaming, right? So that's the beauty. So from basic building blocks like chips to basically high-end driverless cars or artificial intelligence, it's something which these companies globally bring to you, and as a result, they become a good investment fit for you as well. Now, as was explained in the previous example, India, of course, is a large economy. India is some in a very sweet spot right now. But at different points of time, different countries, different geographies do well. There was a time, as was explained in 2011, 12, 13, where because of the high, persistently high oil prices, we had a very significant current account deficit. In other words, we had a lot more spending on dollars compared to our earnings. So we were spending a lot more compared to our earnings. What does that do? That essentially ensures if you spend more than you earn, what happens is your value goes down or you become indebted. That's what happened in India, and our rupee value fell down, as was explained between January and August 2013. Our rupee went from 54 to I think 68. So these are the kind of events which happen and which will probably keep happening as we move along at different points of time. Right now, there is no reason why rupee should depreciate in a very big way. We already saw one leg of rupee depreciation, I think, last year, wherein rupee was stable at about 62, 63, but it moves towards 60, 76, 77 last year when the pandemic struck. And so that readjustment of 12, 30, 12, 13% has already happened. Currently, if we see, rupee is not a worry, but there are other countries which have underperformed sharply. Many of the Asian countries have underperformed India. And like I said, there are various reasons why you want to invest outside. One is there are companies, as was mentioned, which are into innovation, or the global leaders as well, the Starbucks of the world, the Pepsis of the world, which I think you and I have been consuming since probably time immemorial, at least as far as Pepsi and Cola is concerned. But we do not get to participate in it. They are not listed in India. Luckily, some of the large companies globally have their India counterparts which are listed and you can participate in it, but many are not, and that's where global investing can be of uh, good fit. I already mentioned about rupees, so I'm moving on. And like was explained that in investments, you should never put all your eggs in one basket. In other words, you do not want to invest in a single geography, a single stock, a single fund, because it can probably make you or break you in terms of your long-term goals, which you require to be your wealth creation goals, right? So even I've seen people who basically keep deposits or who keep money in fixed income. They have divided between probably two or three accounts instead of having it in one account. So that's the advantage which you have and diversification. That if something goes wrong in one of the investments, you basically can make up for the other. In this case, we would believe that if you pick up the right set of funds which have been advised to you, you may not necessarily lose, but there are certain funds which can do well at different market periods, certain funds which can probably lag. The average of it can actually help you improve your wealth creation journey. And that's why we say do not invest in only one geography or only one sector. And especially and more importantly, do not invest in something because it has done well in the last 1 year. Irrespective of our topic of discussion today, which is global markets, do not invest looking at past returns in any of the products, because if you look at past returns and invest, every time you'll probably be ending up hurting yourself in the long term investment journey. In investments, it is important to enter early and enter cheap, not necessarily enter late. And for sure, in themes and sectors, you have to be careful. Now, you may argue that how am I supposed to know what is cheap, what is expensive, whether I'm entering at the right time or the wrong time? Experience will teach you. And if you can't have, or if you don't have your own experience and you don't have the time, I'm sure there are advisors and distributors who can basically explain you, and there would be enough available material which you can read. So clearly do not chase returns. That can hurt you significantly, and especially at a time where between March 2020 and today October 2021, the global equity markets, commodity markets. I don't understand cryptocurrencies, of course, but most of the markets or risk assets, as they are said, have gone up. So you need to be very sure that where you are investing, it is the right investment for you, and more importantly, does it make sense? So as an investor, like I said, uh, forget Indian markets. If you're investing outside, how would you even know what's happening in that particular country or geography? How would you know, when to invest there, how much to invest there, and how to reallocate? So that's where these are the questions which you probably may not understand. And as was being explained last time, that there are times when the emerging markets do well, there are times when the developed markets do well, right? There are times when India will do well. So between 2000 and 2008-9, it was a golden period for China, India, Asian economies in general, or emerging markets like Brazil, South Africa as well, which basically, if you see the blue line on the left, we did very well till up till 2008. Then, of course, there was a Lehman crisis led fall, the US housing crisis fall in 2008, which brought down the blue line significantly. So, clearly, if you see, there will be times when emerging markets will do well, and last 10 years, emerging markets have done badly. And hopefully, now as we move along, emerging markets do well. India has been a standout outperformer in the last 1 year. In fact, if you look at the kind of outperformance India has had, it is quite astounding and astonishing, because all good things have happened in India in the last 1 year, right? Whatever is happening in China in terms of they fighting their own pollution problems as well as income inequality problems has meant that Indian manufacturing, be it in textiles, chemicals, etc., has helped a lot. So clearly, what happens outside does have an impact in India, and we are being the beneficiaries of it. Having said that, there is still a lot of opportunities outside, and within outside, if we see, the largest market or the world's largest capitalist economy is the United States of America. And no surprise, because they not only have the resources, but they've always invested in research and development. Think of most of the innovations, they would probably be a US company or a European company, more so a US company, which would have probably, come up with that. Valley is very famous and it's known for its, companies. But in general, if you see, US allows innovation, US allows growth, and it does invest a lot in its universities as well. And so US markets are the largest. If you look at what is your international exposure, why do you invest abroad? you're basically getting the world's largest economy and you're getting the world's fastest growing economy as well. Today itself in the morning, the RBI governor was there and they have basically reiterated the expectation that India in this current financial year will grow at 9.5%. That would make us it is the fastest growing economy, one of the fastest growing economies in the world. And US, of course, is the largest economy in the world. So in diversifying between India and the US companies, you will get the best of both worlds. As was explained, it is important to probably keep the exposure levels to international equities maybe between 10 and 20%, which is a right way to go by, while India should be the core part of your long term portfolio. Because whatever happens the next 5 to 10 years potentially belongs to India because of our demography as well as our advantage of whatever is happening globally, especially in China. Uh, as I've already mentioned, that when you investing in US, you're not necessarily only investing in US companies, right? Which are US dedicated. The companies in US are generally multinational companies which have businesses across the world. So if you look at the data, when you're investing in the S&P 500, if you're investing in the US companies, 30% of the revenues are coming from outside of US. So you're getting a true representation of the world by investing in US, and that's basically what the advantage of US markets are. Um, if you look at why should you be investing in mutual funds per se? Clearly, do you have the time or the energy to set up an international account, invest individually, then keep a track? You'll have to probably remit money outside. Once you've remitted money outside, you'll have to probably buy through an international exchange and then probably maintain that portfolio as well. It is quite taxing, of course, and there will be tax implications as well. When you invest through a mutual fund, it makes your life easy. It is as simple as investing locally, and it obviously does not get captured as part of your LRS requirements as well. So when you're investing in an international mutual fund, that is you're investing in rupee over here, it is not part of your LRS cap of $2.5 lakh. So essentially, the rupee part of it is already spoken. Now, just to ensure I basically finish and keep enough time for Q&A, we believe that one of the options which one can look at is the Nasdaq 100. And why do we say so? I'll just give a background now. A lot has been spoken about technology, a lot has been spoken about how it impacts our day-to-day life. But just this Nasdaq 100, it's interesting to go back in history. Nasdaq by itself is nothing but National Association of Stock Dealers Automated Quotation. That's Nasdaq. It was an exchange which was set up in 1971. And in 1985, they came up with two indices, right? Like how we have Nifty and Sensex in India. There are two indices which the Nasdaq Stock Exchange came out with. One was the Nasdaq 100 Financials Index. The other one was Nasdaq 100 Non-Financials Index. So the financials index, because in 1985 financial markets or the financial companies were the larger one, was the more important one. As time went by, the Nasdaq 100 non-financial index, which was even then dominated by technology companies, but it was much smaller. As the technology companies kept on growing bigger, the Nasdaq 100, as we know right now, is essentially the non-financials largest market capitalization companies in the Nasdaq Stock Exchange, predominantly led by technology companies. And if you look at the top names over there, it's essentially the Microsofts, Apples, Netflix, Googles, and there are other companies as well like Intel and AMD, Starbucks, PepsiCo. So you're getting essentially a set of companies. I think Adobe is also there. So you get a set of companies which are not in the financial services space, but in let's say the in the business of doing business, and they are leaders and thought leaders in their own space in terms of what they are doing. These are the largest companies in Nasdaq. They essentially, if you look at Nasdaq 100, it has 44% in technology, 20% in communication services. So your Facebooks, etc., are also there. Alphabet is also there, and which is essentially the Google parent. And if I look at the start of the day to evening of the day, there's no way in which we can run without practically touching upon one of the um, products or services which these companies have to offer. So I would say that Nasdaq 100 is one of the good tools to start your journey or to invest right now. There would be many people who would ask that Nasdaq has done well over the last 5-10 years. It has done well over the last 5-10 years because the underlying companies have done well. So if you and I both believe that the likes of Apple, Microsoft, Netflix, Google, Amazon are likely to be a large part of our day-to-day life. We will continue to shop on Amazon, continue to use probably Amazon Web Services, or our companies will continue to use Amazon Web Services. If we'll continue to use Google for our entertainment or Netflix for our entertainment, it essentially means that these companies are an integral part of our journey. In fact, today, if you look at the advertising revenues that these companies make from India, that is also significant. In fact, in terms of advertisement spends, I think the likes of these companies are being spent upon a lot more by the Indian companies than even the existing print media or the television media in India. So they are obviously becoming a larger part of the advertisement revenue share as well in India. And as we move along, we believe that this will be true for their growth in Asia, for their growth in Africa. So when you're participating in Nasdaq 100 via these companies, you are getting the advantage of the entire universe, so to say, or the 900 crore people, because these are targeting their goods and services towards the people who can, of course, one, afford it, and two, with the penetration of internet and mobile technology, this access to their products or services has become that much easy. And with the online payment mechanisms becoming easier, their paid subscription models are working brilliantly. So, from a investment perspective, this is a good investment for the long run. It should be part of your overall portfolio dynamics. Your asset allocation should allow it to be a part of your equity allocation, because markets can have ups and downs, right? Um, Today, last 18 months, markets are very good. But if you go back in Jan, Feb, March, especially March 2020, everything seemed to be gone in terms of what's happening in the world because of COVID. But today, with the liquidity enhancement which the central banks globally have done, we've seen a significant uptick in the equity as well as commodity and real estate markets, and that is reflecting in India as well, right? If you look at the sales in real estate in India, that is improving. So with this positive buoyancy, India has already done well. In fact, many of the international markets have underperformed India. So this, from a timing perspective, is also a good diversification timing, wherein you basically, whatever equity allocation you want, you can divide it into international equities as well, and keep that little right now, or move that from the Indian equity to the international equity if your overall asset allocation or your equity allocation allows you. And in terms of, if you look at what is the snapshot of Nasdaq 100, as can be seen, it's a pretty good mix of some of the names which are day to day used by all of us. And from a sector perspective, information technology and communication services, these are not the kind of companies that we can come across in India on a day-to-day basis. With that, probably I will stop, and I'll be happy to take questions. Before I move there in terms of questions, I'd just like to say, from a taxation perspective, it is important to note that when you are investing in any international mutual fund, you get the advantage of debt taxation. In other words, you keep the money for more than 3 years, you will get the advantage of post indexation 20% tax. In other words, your cost will go up based on the index, cost inflation index. And on that increased cost after 3 years, or whenever you do decide to book money or book profits, you will see the difference between whatever you've sold and your index cost of acquisition, and you will pay only 20% or 20% tax on it with some cess. So that's the advantage. If it's less than 3 years, of course, you pay the marginal tax. So that's on the taxation part for international equity. That's also basically giving you the advantage of indexation. With that, I'll probably be happy to take questions. Thank you so much.
Thank you, Chintan. Thank you so much for insightful views. We get a lot of questions in every AIKI, and I think a lot of times you would have probably covered that content in your presentation, but you might just have to, because all the questions that I see, I think you've answered most of it already. But then I think it'll be good if you could just reiterate the points, right?
Yeah, so
So
we
the
give
first
prelim
one,
exams, then we give boards, and then after giving boards, we discuss with our friends, right? That, oh, what did you write? What did I write? So I'm pretty much perfectly fine with that.
exactly. Okay. So the first question is how to identify and what are the criteria to select good international funds?
Sure. So, one is most of the international funds have their objectives defined, whether they're investing in Asia or they're investing in Hang Seng, they're investing in Japan, whether they're investing in Nasdaq, whether they're investing in US blue chip equities. So, the criteria is defined. As far as what you need to do to basically bring it on your shelf is essentially decide which geography you want to participate in and how you want to participate in. And if you do not know necessarily which geography, when, and how, then probably you can leave it to a fund of fund, which basically chooses and picks the underlying funds for you. So there are fund of funds also which are available within the market, which can even we have a fund of fund which basically invests across the funds, underlying funds, and picks and chooses the right mix as per what we feel is right for the investor, and that can be chosen as a model. So if you can't do it, then we'll do it for you as a fund of fund. Otherwise, you can do it. The All the mutual funds are anyways regulated. They are well regulated in terms of the expense ratios as well. And most mutual funds, even our peer group, are running it in the interest of investors. So there isn't a challenge. Just that what you need to be careful is that if something has done exceedingly well in the past, right? You need to be sure that in the future also, would it continue to do well, or you are entering at a time where you're probably likely to see a painful period over the next few years. So always keep basically enough ammunition within you to be able to average should something go wrong, and try and avoid investing at one go, or increasing your equity exposure at one go when the markets have already done so well. That would probably become like a self goal in football parlance. Thank you.
Yeah. So I think like mutual funds make our life easy for sure from an investment point of view, and fund of funds make them easier, right? So now fund of funds, in that we don't even have to select which mutual fund. Fund of funds would do that for us. So yeah, okay, great. So whether to go for global, Nasdaq, US, or China, or any other marked as a benchmark for international fund. Any other benchmarks for international fund? Yeah.
So benchmark essentially, or how should you look at the international funds? There is in general global benchmarks which are available. But I would say that rather than worrying too much about what should be your benchmark, you should worry about what should be the underlying fund, or what should be your asset allocation towards international funds. And then once you've decided that, with how much discipline can you follow, that will probably matter more. It's easy to say, okay, I'll go by the MSCI Developed World Index, or I will go by MSCI Emerging Market Index, I'll go by MSCI Asia X Japan Index. But ultimately, what you need is how much wealth you're going to create for yourself and how you're going to invest. And that journey will start by deciding where on how you're going to invest. And I believe that if you yourself can't do it, even within India, if you do not know which funds to pick up or which funds, how to allocate between equity and debt, there are fund of fund solutions for that as well, right? The asset allocator fund of fund. So in global markets, the global advantage fund of fund. So if you can't do it, allow the fund manager to pick and choose for you. But if you want to do it, don't worry about the benchmark. Worry more about how you are going to allocate, what is your equity allocation, how disciplined are you going to be to basically keep that money and average as and when the time provides. Right now, if you see.
Okay. Fair. Okay. And any specific sectors to keep in mind while investing in foreign equities or foreign
So,
countries?
so generally, if you invest in foreign countries, you wouldn't want to invest sectorally. But yes, there have been times where investors have been interested in gold mining companies. That's not a
Mhm.
bad idea, because as and when gold does well, the gold mining companies can do well. There have been times when energy companies have done well. So if you have a combination of energy and gold mining, it's great for the investors. Sectorally, of course, as I spoke, Nasdaq, which is a tech, it's considered to be a technology index. It has diversification, but it is considered to be a tech-based or innovation-based index. That can also be something which can be looked at. So, in general, you'll invest in geographies and not sectors. But yes, the sectors which come to mind are the gold mining or the energy, or Nasdaq equivalent. But otherwise, yes, it is better to invest in diversified funds. So either Asia funds, or in countries where you have a broader aspect. So you can have Hang Seng, or you can have US blue chip, for example, where you're getting a diversification rather than sector. In sector or theme, you have to be very sure of your entry, as well as your long-term horizon, as well as how much you allocate, and the ability to average on the way down. These things you have to be very careful about. Thank you.
Yeah. Yeah. So it's like I always believe that your basics don't change, right? I mean, even for sectoral funds in India, we always say that there's a very small percentage. It's a part of your satellite portfolio. You could look at a very small percentage in satellite funds, and I think the basics don't change if you're investing in international funds as well. It all remains the same. So yeah, great. Thank you. Okay. At which time is the NAV calculated for US markets equity?
Yeah,
That's
so
the next
in
question.
general, if you see, because the US, there is a time zone difference, and thanks for asking that question because that's important. There is a time zone difference. I think US markets start at 7 p.m. India time, or roughly therein and thereabout, and they start at about 1 or 2 a.m. India time. So the NAVs are calculated based on that time period the next day morning. So in general, around 11 a.m. is when the NAVs are declared for the international funds. In general, at least those which are in US. So you can assume that next day morning, around 10 or 11 is when the NAVs will be declared for the international funds.
Sure. Great. Okay. Okay. Um, which should we prefer to invest in US, direct stocks or mutual funds? I know
So
you've
direct
given that explanation in your presentation, but yeah.
Yeah, so direct stocks is something where uh, you need your own study. You need to be able to execute it. Every time you put money outside, you will have a transaction cost which can be significant, a conversion cost which can be significant. So if all these are smaller part of the overall and you have a good deal, great. And if you have the time to follow the international markets, otherwise it's better to have an approach of diversification within international and buy the relevant, let's say, representative fund. So if you want to invest in US, invest in a US blue chip or a Nasdaq or equivalent, depending on what you choose, rather than picking up that one or two stocks. Yes, if you do like that one or two stock because you've done your research or you're working for that company subsidiary in India, whatever as the case may be, subject to compliance requirements, then yes, you can go directly as well. Otherwise, for all practical purposes, it's much easier to invest in a domestic mutual fund, and then uh, everything from accounting to taxation to diversification gets taken care of without you having to worry too much about following up.
Yeah. Yeah. Absolutely. Okay. Um, how would you compare US markets against Chinese markets?
Today they are, I think, diverse in terms of what they have done. The US markets are at an all-time high. The Chinese markets are not. The reason is very simple. US has seen the best of the economic cycle. China is seeing an economic cycle where the government in China is trying to slow down things and improve the air quality there. So naturally, they are slowing down in terms of their production or polluting industries. And in general, the last 10, 12 years, China had grown so much and so quickly that they are trying to maneuver in terms of a slowdown or a more equitable growth, which essentially means that the Chinese equities have not done well. I think on a 1 year basis, they are flat to negative or marginally positive, nothing significant in terms of returns, while US markets have done well. So if you ask me in terms of value versus growth, US is the growth market, China is the value market right now. If you are a growth investor, you can go for US. If you are a value investor, you can go for Hang Seng or China. Of course, Hong Kong is a better way to play China in general, but you can choose between the two. Of course, and also you should remember that value tests patience. So only if you have patience, probably you can go the China way. And also, US is high growth, and high growth at high valuations can also turn against you in terms of a fall. So again, diversifying between the two would also help, having the right allocation. But today, clearly, China and Hong Kong or Asia in general is cheaper than US in terms of the valuations. But if growths don't support or growth goes ori in China, then probably they may remain where they are for a while. So it's a difficult call, but patient value investors can invest in Asia or Hong Kong or China, as the case may be.
Yeah. Oh, absolutely. I mean, a lot of people ask us this question, right? Is it a good time to enter China? So I think it's a similar answer. Depends on you as an investor, right? I mean, if you are a value investor, then China, yes. But otherwise, definitely US if you're a good investor. Okay. How much percentage of our portfolio should be allocated to investing abroad?
Generally, what we say is that not more than 20% because India is a good growth market and we understand India better than we would understand outside. So I think at a time where generally investors don't have any allocation outside, we would say 20% is good enough. But there's no formula around it, right? We would just say 20% is a ballpark number at the max. You can start with 5 and reach 20. There will be a time where India does exceedingly well versus the others, and probably India will have its own pain area. That time you can increase. But as things stand right now, I would say that 80-20 is a good number to go by, where at least international investing shouldn't be more than 20%. But to each investor is own in terms of what is their risk appetite in terms of international investing. Don't invest more than 10% in a single fund is always what I would say. And don't invest outside more than 20% right now, unless you yourself understand international markets well in terms of macros, micros, which is difficult for most people.
Yeah. Okay. Great. Yeah. Okay. Is it taxation? Can you just repeat that because people are asking that question again? So
Sure.
taxation on international mutual funds.
So let me just simplify the taxation structure for mutual funds in general, so that this question or this confusion is never arising in your investment in mutual funds. So there are just simply two types of taxation in the mutual fund space, right? One is equity taxation, one is debt taxation. Equity taxation is for those funds which have more than 65% in domestic Indian listed equities, right? So your typical mutual fund investment into funds which are investing in India, where there is minimum 65% in equity at all points of time, that will have equity taxation, right? And equity taxation, as all of you are aware, is you hold more than 12 months, it is long term. You hold less than 12 months, it is short term capital gains. And long term capital gains for equity funds is 10% plus some surcharge. Uh, and for less than 12 months, it is 15% plus some surcharge. So, just to understand, equity funds are those which have underlying Indian equity minimum 65%. And there it is a 12-month window for a long term capital gains tax. And the capital gains tax rate is 10% for long term and 15% for short term. If you keep less than 12 months, it is short term. On the other hand, anything other than equity funds, it could be debt funds, it could be international funds, anything other than debt funds, your taxation is, which includes the international funds, your taxation and mutual fund is, you have to keep for more than 3 years for the eligibility of long term capital gains tax. And long term capital gains tax is essentially you get the advantage of index cost of acquisition, your cost of acquisition. Suppose you bought something for 100 rupees today. After 3 years, that 100 rupees based on the RBI's cost inflation index, the cost is increased. Very similar to how you would do in a house. All of us know that in house, if you purchased a house 20 years back for say 20 lakhs, today's value in terms of cost because of cost inflation index would go to 80 lakhs or 1 crore. Similarly, if you invested something in a debt mutual fund and you keep your money for 3 years, you get that advantage of cost inflation index. And after your cost is increased by the cost inflation index, suppose 100 becomes 130 and you are selling at 150, 150 minus 130, not 150 minus 100, because your cost is inflation index after 3 years. So 100 goes to 130 in terms of cost. You sold it for 150. So 150 minus 130. So the 20 rupees, which is your capital gains after indexation, you will be basically paying 20% tax on that. So long term is 20%, short term is your marginal rate of tax. Whatever is your marginal rate of tax, you'll pay that. So this is just two taxations which are there in mutual fund: equity taxation, debt taxation, international taxation. That's it. There's no confusion beyond that as far as taxation is concerned.
Great. I hope that really we've got a lot of questions around taxation. I hope that really clarifies, for most people. Okay, so I think with the last question, is there an easy way to keep track of foreign companies and markets for retail investors?
So there are, I mean, is there an easy way to keep a track for even Indian companies? Probably, I would argue, because there is so many companies, right? In Nasdaq, there are 3,500 companies listed.
Yeah.
In NSC, I think there is more than 4,000 companies listed. In BSC, more than 7,000 8,000 companies listed. So, can you keep a track of what's happening in companies? It's difficult. It takes time. Um, I read about 600, 700 annual reports myself, and I find it difficult most times just to read the 600, 700 in a year. And there are 3,000 companies. So you'll not be able to keep a track. What essentially you should do is simply keep reading newspapers, not watch too much of information because it will become overload, and try and probably pick up one sector after another to understand. In general, what I have understood is that if you pick up the top 50 names, that is the Nifty 50, and you read the annual reports, you more or less come to know of what's happening in each sector in India. And if that sector is a global sector, they will also hear what's happening globally. So you'll probably know what's happening. And otherwise, for your global reading, etc., there are enough websites which keep giving you information on what needs to be done. But it's a completely different universe out there, and you'll not be able to keep a track of everything. I'm not able to, honestly, and this is the only thing that I do. So I don't expect that you can potentially do it if you're not
Yeah.
part of the financial world. Thank you.
No, absolutely. Thank you so much, Chintan. Yeah. I mean, that's why I think mutual funds make our life easy. You can just invest in mutual funds. So you don't have to break your head in terms of reading about different companies. We have the fund managers who provide the expert advice on this. So thank you so much, Chintan, for your for all the
Just as a parting comment, if you allow me,
yes,
what
please.
I have learned, what I have learned in my 16 years career is that, and I completed 16 years in ICICI Pro yesterday. But just as
That,
a just as a learning, it's not important for you to know everything, but it is important for you to know what you should not be doing. And for that, that's simply what you should do is uh, read a few books which are considered to be gospel truths in terms of what you should be doing. It is basically on how you should be managing your emotional quotient, or how you should be managing your overall portfolio, what is good for you, and keeping discipline. So these are something where the best investors of the world, and you just Google the best investors of the world for long term, and you will know, and probably read their theory, read their history, and that if you inculcate within yourself, after 16 years also, I find it difficult. It's not easy because
yeah.
human beings work in different emotions, and with so much information overload that keeps happening, it becomes a challenge to keep our mind at peace. But study those books or read those books, know what you should do, more importantly, know what you should not do, and I think in life you will be successful. So don't try to read everything, don't try to know everything what's happening around the world, otherwise probably most of us will go mad. But what we should be not doing is something which we should know, and that we can learn from successful investors of our generation. Thank you.
Great. Thank you so much. Thank you so much. That was truly very enlightening, and I learned a lot today from from your session. So thank you so much, Chintan, for all the nice words, and thank you to
Thank you.
all the audience who've been a part of this session, and for being with us on a Friday evening. So just a quick update for all of you. This Sunday, we are having a masterclass on behavioral biases that you should avoid while investing in equities. It's going to be super interesting. We're going to have a good 1 hour deep dive into this topic. And we're going to have the one in English at 11 o'clock and in Hindi at 12:30. So we're trying to accommodate both the languages. So you will have a masterclass in English at 11 and a Hindi one at 12:30. So please do join us, and we really look forward to an amazing masterclass with all of you. So thank you so much, everyone, and have a great weekend. Take care, and thank you, Chintan, once again. Bye
Yeah,
bye.
this is exactly what people need to. So please attend that masterclass, because I did not know this masterclass is there, but this is exactly what they will need to become successful. Thank you so much. Thanks a lot.
Thank you so much. Thank you.